Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Atkore Inc. quarterly report. Atkore Inc. offers a diverse range of products and services across various industries. The company operates through two main segments, electrical and safety and infrastructure. Under the electrical segment, Atkore provides metal electrical conduit and fittings, plastic pipe conduit and fittings, electrical cable and flexible conduit, and international cable management systems. In addition to its electrical offerings, Atkore also provides mechanical tubes and pipes, metal framing and fittings, construction services, perimeter security, and cable management solutions. These products cater to the protection and reliability of critical infrastructure across various end markets, including new construction, maintenance, repair, and remodel, infrastructure, diversified industrials, alternative power generation, healthcare, data centers, and governments. Atkore's product portfolio is offered under several brands, including Allied Tube and Conduit, AFC Cable Systems, Caftec, Heritage Plastics, Unistrut, Power Strut, Cope, US Tray, FRE Composites, Calbond, and Calpipe. With a rich history dating back to 1959, Atkore Inc. has established itself as a leading provider of electrical, mechanical, safety, and infrastructure products and solutions globally. Atkore Inc.'s stock price has seen an increase of approximately 10.8% since the beginning of 2026, primarily driven by several key news events in late January and early February 2026. The company's strong first quarter fiscal year 2026 earnings announcement on February 3, 2026, was a major catalyst for this positive movement. Atkore reported adjusted earnings per share (EPS) of $0.83, exceeding analysts' consensus estimates of $0.64, and quarterly revenue reached $655.55 million, surpassing the analyst estimate of $650.09 million. Additionally, management updated its fiscal year 2026 EPS guidance to a range of $5.05 to $5.55, signaling confidence in the company's profitability and operational execution for the year. This revised outlook was above the street consensus of approximately $5.02, further contributing to the stock's positive movement. The declaration of a quarterly cash dividend of $0.33 per share on January 28, 2026, also contributed to the stock's appreciation. Dividend announcements often boost investor sentiment and can bolster a stock's price. These combined factors in early 2026 led to a notable increase in Atkore Inc.'s stock value during this period. Atkore Inc. maintains a market capitalization of $2 billion, broadly in line with the industry peer group. Atkore Inc. trades at a lower price-to-book ratio of 1.68 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 51% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has aggressively reduced its share count despite weak revenue growth. This raises concerns about whether buybacks are being used to offset underlying business challenges. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be identified through a thorough analysis of various factors. On the one hand, revenue decline is often attributed to a decrease in net sales, gross profit, average selling prices, and sales volume. Additionally, restructuring charges, depreciation expense, loss on assets held for sale, foreign exchange losses, and pension-related benefits can also contribute to a decline in revenue. On the other hand, revenue growth is typically driven by an increase in sales volume, which was observed in this case, resulting in a net sales increase of $4.2 million, or 0.9%. Furthermore, improved operational performance and cost control in specific business segments, such as mechanical and construction, can also contribute to revenue growth. These factors highlight the importance of monitoring key performance indicators to understand the underlying drivers of revenue fluctuations. The net income of a company underwent a significant decline between 2024 and 2025, decreasing by 67.5%. This substantial drop in net income is largely attributed to the decrease in profit margins. Specifically, both gross profit margin and operating profit margin saw a notable decline. Gross profit margin dropped from 25.8% in 2024 to 19.1% in 2025, while operating profit margin decreased from 10.2% to 3.1%. The primary reason behind this change is the decrease in operating income. This indicates that the company's ability to generate revenue and manage costs effectively has been compromised, leading to a decline in overall profitability. The company's financial performance is a cause for concern. According to the extracted summary, the company is not generating positive operating cash flow. In fact, the net cash provided by operating activities was negative in 2025, standing at -$55,497. This indicates that the company is struggling to generate sufficient cash from its core operations. While more detailed information on the components of operating cash flow is available on page 29, it does not provide a clear picture of the total amount for operating activities. However, this lack of clarity only serves to reinforce the initial finding that the company's operating cash flow is negative. The company's debt level and interest expenses have undergone some changes in recent periods. While the total debt has seen a slight increase of $521,000 from September 30, 2025 to December 26, 2025, it remains relatively stable, with no significant changes mentioned elsewhere. On the other hand, the interest expenses have decreased significantly by $1,310,000, indicating a reduction in financial obligations for the company. This decrease is consistent across multiple reports and represents a substantial drop of 16% compared to previous periods. Overall, the data suggests that the company's debt level has increased slightly, but its interest expenses have decreased substantially. Management is providing a clear outlook on the company's strategy and financial position. One key aspect of this strategy is the adoption of new accounting standards, which will impact income taxes in fiscal 2026 and revenue from contracts with customers in fiscal 2028. The company's performance is also being impacted by external factors, including lower average selling prices and higher input costs. However, management remains confident that sufficient funds will be available to meet liquidity needs for at least the next 12 months, thanks to a combination of operating cash flow, existing cash reserves, and potential borrowings. In terms of capital allocation, management is prioritizing investments in expansion and updating production capacity through capital expenditures. Additionally, there may be opportunities to reduce debt burden by repurchasing or refinancing certain debts. Overall, the company's strategy appears focused on managing its financial position while investing in growth initiatives. The company has a history of returning value to its shareholders through both dividend payments and share buybacks. In terms of dividends, the company has consistently paid out significant amounts over the past 2 years, with $11,138 being distributed in the 3 months ended December 26, 2025, and $11,121 in the same period for the previous year. In addition to paying dividends, the company has also engaged in share buybacks. Specifically, it has mentioned share repurchases in its liquidity and capital resources section, indicating that it has been actively purchasing back shares from the market. This demonstrates a commitment to returning value to shareholders through both cash distributions and reducing the number of outstanding shares. There are concerns about inventory buildup and supply chain disruption. The company's financial records show a significant excess and obsolete inventory reserve of $22,313 as of December 26, 2025. This suggests that the company has accumulated too much inventory, which can lead to wasted resources and decreased efficiency. Furthermore, the increased costs of sales due to depreciation related to a decrease in useful lives of assets at impacted sites indicate potential inventory write-downs. This implies that the company may need to reduce the value of its existing inventory, which can have negative financial implications. Additionally, disruptions or impediments to the receipt of sufficient raw materials resulting from anti-terrorism security measures pose a threat to the supply chain. This could lead to delays in production and delivery, ultimately affecting the company's ability to meet customer demand. That concludes the financial summary for Atkore Inc. Feel free to comment below, and I will be happy to answer them when possible.